as you continue with your discussions on the foreign translations, foreign operations here. So we're going to continue with the foreign translations. Okay, done with the attendance? Done with this one? Nobody's there? Oh, you can't hear my voice?
Yes, can hear.
I thought that nobody's there. Okay, so we're going to proceed with your class. Okay, just stop sharing the attendance. I think that all of you are listening for the attendance. Sorry, a little bit with a bit late. I just finished with this previous class. Okay, so stop sharing this one. We're going to continue with your notes. So the notes that we stopped last time is like 23 or 22. Okay, I remember this one. Okay, so we're going to proceed with this one. Okay, done with the example, done already. So now we're going to translate. Okay, slide 20. This one, after example 3. Okay, so we have done this one. So we're going to proceed with your class with the next notes that you have for the next one. Okay, so we look at the foreign operations here. For foreign operation, we have two types of foreign activity. The other one is a transactions. Okay, and then the other one is a translations of foreign operations. Foreign operations means that you have a subsidiary outside transactions here. Maybe you do a transaction with a company outside Malaysians here. Okay, but the transactions may be done once or 2 times a year. It depends on type of transaction. If that transaction is really with a sales of goods, sales or buys or purchase of good, it may occur more occurrence. But for the maybe if you bought this one is for sales good and services, maybe there is more than once in there, more transaction. But if the one is related with a fixed asset here, maybe it's going to be 2 or 3 times in a year. It depends, maybe less. Okay, for the foreign transactions here, we need to determine which rate that we're going to use to translate the transactions to Malaysian ringgit. So we are using either buying or selling. Selling, which one is depends on the which rate that we're going to use here is in the rate of based on the bank perspective. Let's say Malaysian company has USD. Okay, so now they want to sell the USD. So for the bank here, bank in the positions of buying. So we're going to use a buying rate. Okay, and then if Malaysian want one USD, for example, okay, they need to buy. So they need to buy from bank. Okay, buy from bank. So for a bank perspective, they are in a selling perspective. So the rate that we are using there is a selling because we look at the bank perspective. Selling or buying here based on bank view. Bank view or bank side. Okay, and then the other ones we're going to have a foreign operations here. So foreign operations here, okay, my place is start here. Maybe a rinse now. If you have a problem with the internet, just inform me. Okay, hopefully that's just not a heavy rain. Just started a rinse here. Okay, so the next one we're going to have a foreign operations. Okay, for foreign operations here, is once a subsidiary have a foreign company outside Malaysia. So we're going to have a foreign operation. Okay, this foreign operations here, we're going to have a foreign subsidiaries. Okay, this foreign subsidiary is going to prepare the financial statement in its functional currency. Then we need to translate this functional currency to Malaysian ringgit. So this we're going to look at this one. So for this chapter, we're going to focus more on this one. On how to translate the financial statements of a foreign subsidiaries. Okay, so we're going to translate the financial statement, okay, to financial statement to a presentations currency. So presentations currency here. So when you have, let's say you are parents, so parents, and they have a subsidiary, let's say in a subsidiaries in Singapore. Okay, we have a subsidiary in Singapore. This subsidiary prepare a financial statement in a Singapore dollar, so using a Singapore dollar. So these parents need to prepare a consolidated financial statement. So parents going to prepare the consolidated financial statement. So parent in a positions of presentations currency. So parent need to translate from Singapore dollar to Malaysian. So this is parent currency is considered as a presentation currency. Okay, because parent need to present that financial statement. Okay, problems occur when the presentation currency is not the same as a functional currency. Okay, if you have anything, please voice out because I cannot see the things that you have in that chat box. Okay, so you're going to have this one. So problems here is when the presentation currency is a difference from the functional currency. Okay, so financial statement should be translated using the procedure that we need to use here. So the assets and liability need to translate using a closing rate. Closing rate here is a rate at the end of the year. At the end of the year, income and expense item need to translate using the exchange rate at the dates of the transaction. We need to use the rate at the transaction. But for the income and expense item, since there are many items occur or many transactions occur for the income and expense item, for a practical reason, we're going to use an average rate. So we're going to use the average rate. So income and expense item using an average rate or resulting translation difference. So any translation difference that we have here, it will be recognized in others comprehensive income. So this method known as a closing rate method. So we have two types to translate or two methods to translate the financial statements here. Either we are using a closing rate and then the other ones we are using the temporal method. So two methods to translate here. So the difference between two methods, if the closing rate method is used when the foreign operation prepare its financial statement, financial statement in functional currency, in its functional currency. And then for the temporal method, we're going to use here foreign operation, foreign operation, prepare financial statement, prepare financial statement, not in its functional currency. Okay, so most of the time we are using this closing method because most of the time the foreign operations going to prepare their financial statement using its functional currency. Okay, so this method is known as a closing rate method. Okay, so the translation difference here may exist because of due to the items that are different here is the first item is related with the income statement item. Okay, for this income statement item, we have profit for the year. The profit for the years is being calculated using the current year closing rate minus a average rate. Because closing rate here, we said that we need to use a closing rate method rate, a closing rate at the end of the year. So the profit for the years here, when we prepare the income statement, we are using the current year average rate. But the closing rate need to use a currency closing rate. So the difference exists here because of the closing rate going to minus with this average rate. For this one is for the income statement item, we focus on the profit here. For the assets and liability here, okay, so beginning net asset is a closing currency closing rate minus a prior year closing rate. Okay, for example, now we in the year 2021. Okay, let's say the current year closing rate at the end of the year 2001 minus the closing rate of the year 2020. So this is for the assets and liability. Currently, both of this one is using closing rate and closing rate, but this one is prior year. This one is a current year. Okay, for a revaluation here, if we have revalue the assets here, the revaluation surplus here is a difference between time with a current year closing rate minus the rates of revaluation rate at the revaluation rate. So the translation difference due to first items here is related with the profit. Second items here is related with the beginning net asset. And then the third item here is related with a revaluation. So, okay, for a profit here is a difference between current rate minus average rate. Okay, beginning net assets here is closing rate or closing rate, not current rate, closing rate. Closing rate in the current year minus closing rate at prior year. For revaluation here is a closing rate minus a revaluation rate. That is three items that make a difference. And then I said that the foreign statements, the financial statement of foreign operation are translated into a presentation currency so that the foreign operation can be included in the financial statement of the reporting entity when we prepare the considerations or at the equity method. So it's happened when the presentation currency of the subsidiary. So we need to have this one for a subsidiary when we want to consolidate the financial statements of the subsidiary need to translate to a presentation currency. Okay, it's happened when the presentation currency of a subsidiary or associate here, so associate here equal to the equity method, is not similar with the parents company. So the financial statement that prepared by parent by the foreign operation, the currency used is different from the currency used by parents. There are two methods here. We already know. We discussed here the closing rate method, and then the other one is a temporal method. Closing rate method is used when the foreign operation prepare financial statement in its functional currency. Okay. And then for temporal method, foreign operation financial statement not in its functional currency. That is a difference. So the statement you have to be careful with the statements. So these statements given here to differentiate which method that you are using, either the closing rate methods or a temporal methods. Okay, and then we look at the closing rate method first. Okay, this closing rate method is applicable when a foreign currency is a functional currency of a foreign subsidiary and is prepared. Okay, when a foreign subsidiary prepare its financial statement in its functional currency. Okay, for example, sir, a Malaysian company own a foreign subsidiary in Australia. The functional currency for the foreign subsidiary is Australian dollar. Okay, and it's prepared a financial statement in Australian dollar. In this case, the foreign currency is a financial currency of the subsidiary. So it means that nation's company has a subsidiary in Australia. That subsidiary prepare financial statement using Australian dollar. So we need to translate that Australian dollar to Malaysian ringgit for the purpose of presentations consolidated financial statements. The translation gain or loss. So once there is a translation, we want to translate from USD to Malaysian ringgit. So there will be a gain or loss here. So gain or loss here because of the difference in the rates of exchange. So gain or loss will be reported as an exchange reserve. Now this one reported as an exchange reserve. For this one as an exchange reserve as a separate components of the shareholders' equity. So this exchange reserve here will be a part of OCI. And then later this OCI here will be transferred to accumulated others comprehensive income. OCI here is in your income segment. Accumulated others comprehensive income here is your equity item in your segment of financial positions. Okay. So that is what we have here. Okay, so proceed. So the closing method, how we're going to translate here. Okay, to translate here statements of the income segment or statement of profit or loss and others comprehensive income or revenue and expense here will be is using the exchange rate at the dates of the accounting recognition. But normally assumption is made that the revenue and expense are incurred evenly throughout the year. So we are using the average rate. Okay, the average exchange rate for the years is 6. Okay, depreciation and expense also translated at the average rate of the year is as we assume that this expense accrued eventually throughout the year. So for gain or loss that occur in and at a specific time. Okay, any gain or loss that occur at a specific time, for example, here is a revaluation of asset. The exchange rate that we use here is the rates at the date when the applied. So if there is a revaluation, remember that revaluation is item in others comprehensive income. Yeah? If there is a revaluation, so the rate that we are using here is a rate at the revaluation date. Yeah? So the rate that we are using here is rate at the revaluation date. Okay, and then to translate the statements of financial positions, so all assets and liability, okay, using the closing exchange rate. So closing exchange rate here is at the end of the year. Assets and liability using a closing rate. Shares and capital and pre-acquisition reserve using the exchange rate at the acquisition date. Shares capital and pre-acquisition reserve using the rate at the acquisition date. Okay, assets and liability using closing rate. Okay, shares capital plus pre-acquisition reserve. Okay, using the rates at the acquisition. Okay, revaluation reserve. Okay, using the rate at the revaluation. Revaluation reserve. Okay. So at the date when there is a the revaluation was done or what's made. That is the rules on how to translate. Remember that? Revenue and expenses using the average rate. Post acquisition profit brought forward. Okay, this is be careful about this one. Post acquisition profit brought forward. So means that profit, the income statement item, let's say in the year 2020, when you brought this one to 2021, should be based on a prior year closing balance in ringgit. So we need to use this profit that we brought from year 2020 to 2021. When we translate here, we need to translate using a closing rate at year X2 2020. Not closing rate. It should be based on the prior year closing balance average rate in the year X 2020. Yeah? Later on, we look at this example of this one. Yeah? The translation gain or loss is reported as an exchange reserve. Okay, put it in others, accumulated others comprehensive income. And then the problem about this one, yeah? The exchange reserve is derived as a balancing figure. So balancing figure here means that this exchange reserve is a part of your equity. Yeah? This one is a part of your equity. So you need to find your net asset. Remember that you need to look at here the net asset, which is asset minus your liability here, should equals to your equity. So the balancing amount here is your exchange reserve. Okay. Maybe you don't understand this one yet. We're going to look at the example later. Okay, and then another item that we have here is a goodwill. Goodwill on consolidation, they need to use the historical rate. Okay, so goodwill here, going to use historical rate to translate shares capital and pre-acquisition reserve that stem from the fact that parent shares of the subsidiary the asset at acquisition should not change with the subsequent consolidation, so that the goodwill on consolidation should first be re-established. So you need to find the goodwills like the one that you find here. The goodwills here is a difference between the CUI minus the net identifiable asset. Okay, and then we're going to find the goodwills, and then that goodwills need to, as this goodwill is become your asset. So for this asset, when you translate here, you need to use a closing rate. Okay. And then, so the goodwill on consideration should be first re-established by the permanent adjustment that was used to eliminate the COI and shares of net asset. So the goodwills, have to be careful for the goodwills. Okay, so going to look at here. So remember that there are 4 items that make a difference. Okay, that lead to the exchange difference. Okay, the first item is your beginning net asset. Okay, the second item is a profit. The third item here is a revaluation, if you have any revaluation, and then the fourth item is a goodwill. So these four items make a difference. Make a which is going to contribute to the difference in the exchange rate. Okay, we try to look at these examples here. We try to look at this example. Expansion Berhad is a Malaysian company that are traded internationally, acquired a solid wholly owned subsidiary. So wholly owned subsidiary means that they have 100% shares in this foreign public limited company. On 1st of January X2. So the acquisition date was 1st of January X2. Okay, acquisition date. At the cash considerations of 2.5 million, they paid 2.5 million ringgit Malaysian. Okay. The shares capital of this foreign company consists of 10 billion equity capital of 1 peso. So this one is in a foreign currency. Yeah, foreign currency. And the return profit was 5 million. So if you look at here, the net asset on 1st of January X2 here, the net asset you have 10 millions, okay, and then plus another 5 million. 10 million from shares capital and then 5 million from the RE. So altogether you have 15. Okay, and then on that date, on the X2, the exchange rate was 10 peso to 1 ringgit. 1 ringgit is equal to 10 peso. So remember that your COR here is in your RM. Now you need to translate this one because the amount of shares capitals here and the RE here is in peso, so you need to translate from ringgit Malaysian to peso. So 1 ringgit Malaysia is equal to 10 peso. So 2.5 here you need to find with. So the total COI that you have here is equals to 20. Okay, we need the time because we want to convert from 1 ringgit Malaysia to 10 peso. Okay, because this is the rate on 1st of January rate at the acquisition date. So if you look at here, this UI is 25, the net asset is 15. So you're going to have here your goodwill sale will be 10. Okay, this one is already in peso. So remember that this one, the goodwill sale is 10. We're going to use this information later. Okay, the financial statement of the expansion Berhad and its subsidiary for the year ended 31st December is measured in their respective functional currency. Okay, so this is a financial statement. So financial statement that we have on 31st December X3. So you acquired this one on 1st of January X2. Now it's already X3. So you're going to have 1 year. First year, this one is already the second year. Okay, this one expansion was prepared in Malaysian ringgit. Okay, but for foreign here is prepared in peso. So the thing that we need to focus here, we need to focus on this foreign because we need to translate this foreign. We need to translate from peso to ringgit Malaysia. So this is what you have. So income statement item. So remember that we are using the closing rate. So for closing rate, when we translate, okay, closing rate method, we are using closing rate method. Revenue and expenses should use the average rate. So income segment item here is revenue and expenses. So revenue and expenses is starting from here up to this one. This is your revenue and expenses. This is another item which is your OCI. It's not related with your revenue and expenses. So all the revenue and expenses should use the average rate. So look at the one that you have here. So if you look at here, this is the total profit, the one that you have. And this is another thing that you need to highlight. Later on, you're going to use this information. Okay, revaluation surplus. This is another thing that you need to highlight. Okay, so you look at here, the RE brought forward here. So RE brought forward here is RE at 1st of January at 3. So means that this is RE ending RE which is on 31st December X2. So if you look at here, you acquired this company on 1st of January X2. when you acquired here, the RE here was 5 million. Now at the end of the year, the RE becomes 7 million. So there is an increase by 2 million. So increase by 2 million is equal to the profit for the year X2. Right? So profit for the year X2 is 2 million. Okay, please remember later on we're going to use this figure also. Okay, this is the RE brought for carry forward. So this is important figure that we're going to analyze later. Okay, so this is your income statement. Okay, the next one we're going to look at your segments of financial position. Okay, the segments of financial positions here. Okay, this is the amount of PPE. Just focus on this figure. Highlight this figure also. This one also. To use this information later. Okay, and then you have a long-term loan and so on shares capitals here. Okay, revaluation reserve. Okay, this is another item that we're going to focus on. So this is information that we have here. Okay, look at the additional information. Okay, so for additional information, it said that on 30th September X3, 30 September X3, both expansions and foreign PLC revalue their respective property. Okay, and then incorporate the surplus in their account. So both of the company have a revaluation and then they have a surplus. So we focus on the foreign first because that foreign we're going to translate it. Okay, for foreign's here, foreign's has a revalue on 30 of September. So, okay, we refer back to the value that you have in the foreign here is 13. Yeah, so 13 here. So that 13 here is already include the amount of revaluations of 6. It's already include the amount of revaluation 6. So means that the original cost that you have here, okay, is 7. So this one is the original cost of the assets. Okay, now the beginning balance of this asset here is 7 because we have revaluation surplus of 6. So that is what we have. Okay, now you have here the average rate for the year X2 is 8. So we're going to use this one for to translate the income statement. So this is the rate for the income statement. But this one is now in the year X3. We need to use this information later. Okay, focus on this one. Average closing rate inventory and then average closing rate inventory in X3 here is for a temporal method. We don't need to use this one for a closing method. Yeah. Okay, this is a closing rate. So closing rate in X2 here is 6. So this is a closing rate. X2 here is also considered as a closing rate of a prior year. Because now we are in the year X3. Yeah? Okay, and then this is average rate for the year X3. So when you translate the income statement in X3, we're going to use this figures, this rate. Okay, 30 September here is a rate for a revaluation. So this rate going to use for a revaluations of property. Yeah. Again, I'm not going to use this information because it's related with the temporal method. On 31st December here is a closing rate in a current year. And then 1st January here is at the acquisition date. Acquisitions rate. Okay. Okay, the average rate for the years can be taken as an approximate of the rate ruling at the date of transactions during the year. So we're going to use the average rate to translate your income statement. There is no annualized intercompany profit. Okay, this rate here, if you look at here, this one is a from peso. We want to translate to Malaysian ringgit. Peso to Malaysian ringgit. So for example, say you have 8 peso is equal to 1 Malaysian ringgit. So once we translate from peso to Malaysian ringgit, we need to divide. So this is to guide you. If you given there is foreign, okay, foreign to ringgit Malaysia, we need to divide. If that one is a ringgit Malaysia to foreign, we need to divide. Yeah? So this one 8 Here we have to divide the rates here. We need to divide because we want to translate from peso to ringgit Malaysia. So please, if you have any question, you voice out. I cannot see the things that are in the chat box. Okay, now we're going to prepare the consolidated account. So before we prepare the consolidated account, we need to translate your income item first. Okay, financial statement. Yeah. Okay, the first financial statement that we translate here, we translate the P&L. So profit and loss here. So we only focus on foreign, focus on the foreign here. Okay, so we look at here the sales here. So that remember the item for income statements. Starting from sales until this one, we need to translate using average rate. So average rate X3 here in X3. The average rate for X3 here is what you have here. 5 ringgit, 5 peso. 5 peso to 1 Malaysian ringgit. 5 peso to 1 Malaysian ringgit. Okay. So the rates here is 5 peso to 1 Malaysian ringgit. So this amount, all of this item in your income statement need to divide by 5 because you want to translate from peso to Malaysian ringgit. So 25 divided by 5 for the order rest the same thing. Yeah? So you're using the same rate. So you're going to have here total profit after tax here. Okay, is 1232. This is the profit that we have here. Okay. This is how we're going to translate and we're going to divide because we want to translate from peso to Malaysian ringgit. So I give you an example for the opening inventory. 4,000 divided by 5, so you're going to have 800 here. Okay, now we have done with the items. So the profit for the years here, profit after tax for X3 is 1232. Okay, now we look at the others comprehensive income. In others comprehensive income, you only have a revaluation surplus. So remember that the revaluation surplus here is you need to use a revaluation rate. So revaluation rate at 30th of September, the rate given here is 4 ringgit and 50. So divide with 4 ringgit and 50, you're going to have 133. Yeah? So 133. So you can prepare this one up to this one only because this exchange translation scheme here is amount of exchange translation is derived only after the financial statements positions has been as statements of financial position has been translated. So means that you can translate your income statement up to this point only, but for the exchange translation gain here, you need to translate the statements of financial position because this information is will come from these translations of statements of financial position. So we can stop up to this one only, then we need to find this figure. So how to find this figure? We need to translate the statements of financial position. Okay, so now we're going to look at the statement. Any questions that you have for the translations of the income statement? So income statement is a simple, just using the average rate. Translate the average rate. The important things you need to know whether you want to times or you want to divide. Okay, but the times or divide it depends on the rates here. If given here is peso to ringgit Malaysian, means that foreign to ringgit Malaysian, you need to divide. If ringgit Malaysians to foreign, then you need to times it. So the difference here is only for a revaluation reserve. Yeah. Okay. So the next one, we need to translate the statements of financial positions. Okay, so statements of financial positions, remember that assets and liability should translate using a closing rate. Closing rate at X3. So closing rate at X3 here is 4. This is a closing rate. X3 is 4. So all the items here, you need to divide with 4. Okay. So this is what you have. Okay, for all the assets liability, and then this is your liability. So you want to find your net asset. Okay, focus on this one. Okay, so since you're going to have a goodwill on consolidations, so that goodwill on consolidation is a part of your asset. So once this is a part of your asset, when you translate this one should translate using a closing rate. Okay, the goodwill should be a closing rate. So you total up, this is your net asset. Okay, net asset still means that asset minus your liability. So your net asset that you have here is 9792. 94. So you need to find the next asset. Net asset 9794. Okay. Because later on we want to look at the equity section. So because in this equity section there is elements of exchange difference or exchange reserve. Okay. So this is your net asset. So remember that your net asset is equals to your equity. And then we need to find the exchange reserve in your equity. Yeah? Okay, so we proceed here with the equity here. So the equity, you have a shares capital. Shares capital was issued at 1 ringgit each. So 1 ringgit that you have here is 10. 10 here is a shares capital that you have is 10. 10 and then the rate at the acquisition date. So this is rate at the acquisition date. The acquisition date, rate here is on 1st of January. X2 here is 10 peso to 1 ringgit. So this one divide by 10. So you're going to have 1. Okay, look at here. The revaluation reserve. So I put a goodwill here. So the goodwill was exist during the acquisition state. Yeah? So the goodwill was exist because of the increase in the value of assets. Increase in the value of asset. So this one is considered as a increase in a revaluation reserve. When you revalue the asset, the value of assets means increasing. So you're going to put it's a goodwill here. The amount of goodwill here is 10. Okay, and then 10 should use the acquisition statement. So remember that the goodwill here in the shares capital here in the equity sections, you're going to have a revaluation reserve. Two types. One is for the goodwill. This one is a revaluation reserve at the acquisition date, which is referred to your goodwill because the value of assets have been reserved. Okay, so you're going to have here the goodwill here is 10 million. 10 divided by 10. Yeah? So you're going to have here is 1 million. Yeah? Okay, and then you're going to have revaluation reserve, but this one is post acquisition. After the acquisition, which is referred to the revaluations of property. Yeah? Okay, revaluations of property. Okay, you're going to have here is 6 million. 6 million time with the rate, not time, divide with the rates that on the revaluation date. Okay, revaluation date, the rates here is 4 ringgit and 50. Yeah? So divide here, you're going to have 133. Yeah? Okay. And then for post-acquisitions profit, okay, sorry, for pre-acquisitions profit, this is your RE at acquisition. Yeah? Okay, acquisition. So RE at acquisition, you have 5. So 5 here divide by 10 because this is at the acquisition date. Yeah? Acquisition date. Yeah, so you have 5 here. Okay, and then look at this one. Post-acquisitions profit. Yeah? Okay, for post-acquisitions profit, you have two elements. You have two elements. The first element is balance brought forward, and then the other element here is a currency profit. Why you have a balance brought forward here? Because now you are in the year X3. The balance brought forward here is from X2 profit. Yeah? X2 profit going to be brought to X3 to X3. Yeah? So balance brought forward, you have 2 millions. Where does 2 million come from? It's a 7. 7 is from the RE brought forward minus 5. So you're going to have 2 million. So you're going to have 2 million. So the rate that we are using here, since this is a profit for the year X2, so we're going to use the average rate X2. So you're going to have here is 250. Yeah? So how are you going to calculate this one? 2 million divided by average rate X2. Why you are using the average rate here? Because this profit is come from your income statement item. So income statement item, you are using the average rate. Yeah? So you're going to have here is 250. Yeah? Okay, for a current year profit 6160, we're going to have 1232. So 1232 is come from your income statement. We already translate the income statement. So this is the profit that we have here. Okay. Now altogether you have here for the RE here. So post acquisition profit, you're going to have 1482. 1482. So you total up all these figures here. So you're going to have here altogether, you're going to have If you have total up that figures all of that figure, you're going to have 15115, I think. Okay, you're going to have segment. Okay, 511. Okay, 5115. Okay, 51515. So you need to have that total equity should equal to your net asset. So your net assets here is 9790. So your equity also should have 9790. So now up to this point, your equity here is only 51515 here. So we need to have another 4475. So 4475 here is used to balance it. This is what you mean by to balance. So to balance it, we need to have another 4475. So this 4475 here is your accumulated others comprehensive income. So your accumulated, since the word accumulated here, so this is a combination of X2 and X3. Okay. So you're going to have that combinations of X2 and X3. So now we need to write your income statement here. So the income statement that we have here is for the year X3. Okay, we have income statements that we have here is for the year X3. This 4475 here is a combinations of X2 and X3. So we need to know how much exchange difference for X2 and then how much exchange difference for X3, because this one is already a combination. Okay, so any questions that you have up to this point? Any questions that you have there? Any of you is okay with that one? So the exchange difference here is only to balance it. To balance it. Any questions? Are there any questions that do you have a questions? Hui, are you still there? Hua, Lee, are you still there? Oh, nobody is there. Any of you? Okay, so we proceed now. I'm afraid that two silence there. I thought that you are not there. Okay, just proceed now. Okay, so we're going to proceed. Okay, so now we know that from that 4475, from that 4475, we need to find how much the exchange difference for the year X2 and then for the year X3. Okay, for this one, we already done. We calculate the goodwill here. We already done for this one. Okay, so already calculate previously. We done about this one. So look at this item. So this item is very important. The currency translation difference can be calculated using the following formula. Okay, so there are four items that make a difference, that create a currency difference here. The first one is a beginning net asset. The second item is a profit. The third item here is a revaluation. And then the fourth one is related with the goodwill. So we have four items here that make a difference. Okay, the first one is a beginning net asset. The difference here, because of the beginning net asset, we're going to compare between the current year closing rate minus a prior year closing rate, current year, and then this one is prior year. So the rate will be different here. So that's why I'm going to have a difference here. Okay, and then for the profit for the year, we are using a current rate minus an average rate. Okay, why you are using current rates here? Sorry, why we are using a closing rate here? Because we are using a closing rate method here. So we are using closing rate minus the average rate. Okay, for a revaluation here is a closing rate minus a revaluation rate. Yeah? Okay, for goodwill here, you have to be careful. Okay, for the goodwill here, start with the rate at the acquisition minus current year closing rate. So the difference between closing rate and then rate at the acquisitions. Okay, rate at the acquisitions. Okay, rate at the acquisition. And then minus the prior year adjustment. Okay, prior year adjustment here means that the adjustment in the year X2. Yeah? Okay, in this example here, it's adjustment in the year X2. Okay, we're going to look at the example, then you understand about this one. Okay, and how we're going to calculate based on this 4 item. Yeah? So if you refer to year X2, okay, for X2, we're going to have beginning net asset. We're going to have that item. Profit we have. Revaluations, no. Because these revaluations happen in the year X3 year. And then we're going to have goodwill. So 3 items in X2. Okay. And then in X3, we're going to have 4 items that make a difference here due to the beginning net asset, profit, revaluations, and also the so for goodwill here, listen, be careful now because you are in the second year. So we need to use this formula. Now we try to look for the year X2. Okay, so it said that the exchange reserve reported in the translated financial position is 4475. Okay, this 4475 here is accumulated amount for the year X2 and X3. Yeah? Accumulated amount. So we need to find how much the exchange difference for X2 and then X3. Yeah? Okay, so we said that for X2, we have 3 items, net asset, beginning net asset, profit. Okay, next we see the beginning net asset, profit, and then goodwill. Okay, 3 items. Okay, so for the net asset here, since how for net asset, how we're going to calculate here is a difference between current year closing rate minus a prior year closing rate. Okay, so this is a formula for the net asset. For the profit here is a current rate minus average rate. Okay, for the goodwill here is a current rate minus acquisition rate. Okay, because this is a first year. First year, so prior year here, we're going to use since this you acquired your company this company on 1st of January X2. So your prior year is we are using the acquisition date, acquisition date because that is your prior year. Okay, now we look at the shares capitals here. Okay, for shares capitals, the one that you have here, if you look at here, closing rate that we have, okay. So the closing rate at the year X2 was 6. The rates was given. The closing rates was 6 at the X2. So this is the closing rates at 6. And then the opening rates here is 10. Yeah? Opening rate is 10. So the difference that you have here is 4. If you look at here, it's 4. Okay. Okay, so you're going to have 4, 15, we got 15. Okay. So this is what you have. Okay. So now we're going to look at the closing rates here is 6 peso. So 6 peso, if you convert this one to Malaysian ringgit, will be 1 divided by 6. So we're going to have 0.167. Yeah? And then the opening rate that you have here is 1 divided by 10. Yeah? So we're going to be 0.1. So if you look at here to determine whether there is a gain or loss here, gain or loss here, you just compare between this one. The closing rate is 0.167. The opening rate here is 0.1. So there is an increase. So increase here means that we're going to have a profit. Yeah? So the difference that we have here is 0.067. Yeah? Okay, so time with 15. Yeah? So time with 15. Yeah? Okay, 0.067 and then time is 15. So you're going to have here is 1005. Like this one, yeah. So this one. So most of for this topic here, for the foreign currency exchange here, they're going to mention which how many decimal point that we're going to use because there will be a decimal point for this topic. So be careful because the calculation will apply here. Okay, so based on the calculations here, we're going to have 105, but this one we're going to have 1 only. So if you want to use this one, either one. So if you divide with 15 divided by 6, okay, you're going to have here is 2.5. And then 15 divided by 5, we're going to have 1.5. So either one, either way, are using this one. So I just show you this one to determine whether there is a gain or loss here. So you need to look at, you need to compare. The closing rate was 1 ringgit and 67. The opening rate here is only 0.1. So it means that when there is an increase, means that we have a gain. Okay. The next one, you have the profit here. So the profits here, we're going to compare between the closing rate and the average rate. The closing rate is 0.167 or 0.17, and then the average rate is 0.8. So 0.8 and 0.8. So 8. So the average rate is 8. So 8 here, if we're going to have here, how much you have for that one? 8. So this one will be 1 divided by 8. Going to have 0.125. Okay, so it seems that there is also an increase. So increase here means that we can have a profit. Okay, so 0.442. Okay, time with 2. Okay, they're going to have here 0.042. So you're going to have time with 2. Going to have it here is 84. 84 or 83. Okay, this one is 83. I'm using this one. Okay, and then for the goodwills on consolidations here, so what you have, wait, check for. The voice is too okay, so I'll try to this time. Okay. Okay, so just repeat this one once again. For this one, for the net asset, we're going to compare. Is it clear now? What? Is it clear? Oh, is it clear now? So we're going to proceed with this one, yeah? Okay, so you have the net asset. So the net assets here, we're going to compare between the closing rate and the prior year closing rate. So prior year closing rate, since this is the first year, so we are using the rate at the acquisition state. Okay, so if you look at here, you compare here. So 6 divided 1 by 6. So this one is to determine whether you have a profit or you have a loss here. So if you look at here, the closing rate is higher than the uh, opening rate. So you're going to have a profit here. So you can use this one, either you just based on this calculation. So I'm referring to this one. Okay, for the net asset, we're going to, sorry, for the profit here, so the profit here, we're going to compare between the closing rate and the average rate. We're going to compare between the closing rate and average rate. So the closing rate that you have here is 0.167. Compare with the closing rate is 0.125. Yes, so it means there is an increase also. So increase by 0.042 times 2. So you're going to have 84 here. Okay, and then for the goodwills here, so the goodwills here, we're going to compare between the closing rate and acquisitions rate. Yeah? So the closing rate that you have here is 0.167. Okay, then the acquisition rates here is 0.1. So you're going to have here 0.067. So time with 10 million. So you're going to have 667 here. So of this one is a gain. So total out the gain that you have here is 1757. If you look at here, once you already, since this is only 2 years, okay, so you know that the amount, where is my pen? Okay, so since that you know that the amount of the X2 and X3 exchange difference here is equals to 4475. Okay, so exchange difference for X2 here is 175. Okay, then so means that we're going to have the difference here is 2275 here is exchange difference for X3. Yeah? So based on information X2 here, you can find the amount of the different in X3, exchange different in X3. But you need to show this one also, the same calculation like the one that you have X2 here, because if you have more than 2 years. In this example, it's simple because you already know x2, so you can find the difference here will be x3. Okay, so in the case when the translation accumulated exchange difference is more than 2 years, then you need to show the calculations here. Okay, so we need to calculate for the year x3. The same thing for the year x3. Okay, well, is it okay now? The boys, is it okay? I haven't got your answers here. Is it okay or not okay? Any of you? Is it okay, Uy? Any of you there? Okay, so we proceed now. Okay, so now the same thing that we need to do for the year x3. In this example, it's simple because you only have 2 years. If the accumulator is more than 2 years, then you need to show for every year. Okay, for year x3, so we move to year x3. Okay, for x3, the same thing that we need to do. So remember that we have a difference due to 4 items here. Beginning net asset. First, the second here is a profit. Okay, and then the third one you have a revaluation surplus, and then the other ones you have a goodwill. So be careful with this goodwill this time. Okay, we start with the beginning net asset. Okay, beginning net asset that you have in the year X3 is the asset that you brought from the year X2. So X2, okay, for X2 you have a shares capitals of 10. Return profit at the acquisition is 5. Okay, so and then you will know that there is a profit for x2 which is equals to 2. So altogether you're going to have 17. So this is what you have for 17. So 17 beginning net asset. 10 from shares capital, 5 from returns earning, and then another 2 here is from the current year profit. Current year profit here is a year X2 profit that we brought because this one is a beginning net asset. So it means that the profit in the year X2. So altogether we have 17. So 17 compare with the closing rate and the opening rate. Opening rates here is all previous year rates. Previous year closing rate. So previous year closing rates here is a rate at the end of X2. Closing rate at X2 is given here as a 6. So we're going to have here. So if you look at here, we need to determine whether you have a gain or loss here. So 17 divided by 4, 17 divided by 6. So if you want to determine the gains of loss here, is 1 divided by 4 here, you're going to have 0.25. This is the closing rate. And then 1 divided by 6, you're going to have here, the difference here is 0.167. So means that there is a gains here. So gains that we have here is a 0.083. Yeah? It's 0.083. So time is 517. So we're going to have here 1417. Or we just divide this one, divide this one using I'm using this one. So this one is to determine whether there is a gain or loss. Okay, that's another way. Okay, and then for a revaluation surplus, so for the beginning net asset, we're going to compare with the current year closing rate minus a prior year closing rate, or using a beginning balance, same thing. Okay, and then for revaluation surplus, we're going to compare between closing rate and revaluation rate. Okay, closing rate is 4. Okay, so 4 here is 0.25. Here 4 is 0.25. And then the revaluation rate. Okay, revaluation rate that we have here is equals to, how much you have revaluation rate? Is revaluation rate is 4.5. It's 4.5 here is 0.22, isn't it? 0.22. Okay, so 0.22. So the difference that is it 0.22? 1 divided by 4.5. Okay, 0.2223. Yeah, okay. So the difference that you have here is minus 0.25. So you're going to have the 0.2267. So we're going to time with 6. So you're going to have 167 times 6. Okay, so there is an increase, so they're going to have a gain here. Okay. And then for the profit for the year, so this is the amount of profit you compare between the closing rate minus average rate. Yeah. So closing rate is 4, which is 0.25. Close average rate here is 0.2. So the increase that you have here is 0.0. Okay, compare with this one 0.05 times with 6160. So you're going to have 308 again profits. Increases again. Okay, look at the goodwills here. So the goodwills here based on the formulas given here, the goodwills here is a goodwill time with the rate at the acquisition minus the closing rate minus a prior year adjustment. Okay. So for the goodwills, okay, for the goodwill time with a closing rate minus the acquisition rate and then minus a prior year adjustment. So prior year adjustment is a goodwill in adjustment in X2. So goodwill adjustment in X2 here is 667. Yeah? Okay, so for the closing rate that we have here is 0.25 before, and then you compare with 0.1, so you're going to have 0.15. So 0.15 times with 10 million, so you're going to have 1.5 million. So 1.5 million is a goodwill, goodwill for increase in the profit for the goodwill, but we need to minus a prior year adjustment. So prior year adjustment is adjustment for the year X2, so we're going to have 667. So the total gains that we have here is 833. Yeah? So 833. That is a gain. So total up all the gains that you have here is 2725. Yeah? So total transaction exchange gain here is from A and B. A here is for the year X2, you have 1750, and then for B here is 2725. At the end, you're going to have 4475. Okay? So this is what you have. Okay, and then after you already translate your income statement and statement of financial position, we need to prepare the consolidated. Yeah? Okay, for consolidated, you just total up all the expansion plus a foreign after we translate them. So total up all the item that we have here, so all the things that we have here. The difference here is one. This one is 133 here is the total amount of the revaluations, revaluations right, for the foreign. Yeah? And this is a revaluation for expensive. Okay, return profit here plus this one is from foreign. Yeah? Foreign. Okay. 1482. 1482 here is from the foreign income statement. Yeah? 1482 here is foreign income statement. 1232 1482 return profit here is from the income statements that you translate previously. Yeah? And then this is what you have for the consolidated income statement total up here. So this is a difference that we have. This one is from a revaluation surplus from in foreign. So total here will be 13113. Yeah? That is what. And then look at the exchange translation difference here is only for a currency only. So a currency you have 2725. This 2725 here is only for parents for foreigners because this exchange difference exists from foreigners only. Okay, and then the next one is a segment of changes in equity. Shares capital is 20. Revaluations at 11. 133 here is a combination of expansion plus foreign. Expansion has a 10, foreign has 1.33. So altogether you have 1133. And the exchange revaluation reserve brought forward here is from X2. And then for the total comprehensive income here is the exchange difference that you have in here X3 here. So altogether we have a 4475. This one is your accumulated others comprehensive income. Yeah? Okay, and then for return profit you have 5 from expansions plus 250 from foreign, the one that you have in the totals that you brought forward for the profit for the year. 250. 2 million divided by 8. So you're going to have 250. This one is from foreign. This one is from expansion. So 2725. Okay, later on I answer that question. So Okay, and then total comprehensive income 13,552. Where do you get this 13,552 here? 13 here is from the parents. Okay, parents comprehensive income. If you look at the parents comprehensive income, parents have a comprehensive income here. Okay, look at that one. Total comprehensive income revaluation surplus. Okay, 13,552. Okay, and then the other one minus the dividends that we have. 4. Okay, that one is our return profit. Return profit for parents that we have here is 13,320. Okay, this one is 13,320. Let's see that one. 13 or 12,320 for the parents. Okay, total up is two figures. Yeah? Okay, go back to your questions here. What is your questions here? Where to find 2725? Okay, back to this one. Okay, you mean this one, 2725. So is it this one, Puah? Okay, 2725. 2725 here, the income statement. Oh, the income statement, this one is the one that you find based on your calculation, isn't it? Okay, so this and in your income statement, so remember that. Okay, you mean this one, Puah? This one, is it this one? This slide 41. Okay, this slide 41. Okay, so we said that we prepare the income statement for the year 31st December X3. So 31st December X3. So we're going to combine between expansion and foreign. So we look at the income statement. We look at the information that we have in the income statement at the beginning before we do anything, before we do a translation. So if you look at here, so for this one is the statements of income statement for parent. This one is for parents. Okay, for parents, if you look at here, there is no exchange difference yet. Okay, so now after you translate here, okay, after you translate here, you look at there is a exchange translation gains here. So exchange translation gain here is 2725. So 2725 only was in foreign company, in foreign. So when you combine here, you combine between expansions and foreigns. Yeah? So when you combine here, expansion, there is no more exchange translation gain. The exchange translation gain is only exists when you translate the financial statements of the foreign. Yeah? So the amount of exchange gain here is 2725. Okay, this 2725 going to transfer to your consolidated income statement. Yeah? Okay, is it okay with this one? This one? So this is exchange transaction gain in the year X3. Okay, so this is what you have here in the income statement X3. Okay, it's come from the translations of. Okay, is it okay? Or is it okay with that one? Okay, so now you prepare a consolidated, isn't it? You prepare a consolidated. If you look at here, in a foreign income statement, okay, once you translate, okay, the translated, there is a exchange translation gain, if you look at here. This one. This one. Okay. So now you want to combine, isn't it? This item exists in a foreign company. exist in a foreign company. So once you combine with parents here, so this item going to exist in a consolidated financial statement. These figures come from here. Okay, is it okay for? Okay, so done with that one. So 4 item. The thing that important here is this formula. Very important about this one. You need to remember 4 items that make a difference, that create a translation difference here. Relate with the beginning net asset, but make sure that you know how to calculate the beginning net asset. So for a beginning net asset, we're going to compare current year closing rate minus a prior year closing rate. And then profit current year compare with the average rate. Revaluations current year minus a revaluation rate. Goodwills here, okay, current closing rate compare with the rate at acquisition and minus a prior year adjustments. Yeah. So this is what you have, okay, and then you have this one. Okay, and then the other method that we have here is a temporal method. So, okay, for a temporal method, just want to discuss a little bit on it. For a temporal method is applicable when a foreign currency subsidiary prepare its financial statement in currency which is not is a functional currency. It means that the foreign subsidiary, let's say in the Australia, do not prepare using Australia dollar. Okay, AUD. Okay, using Australia dollar. They may use another currency. Yeah? Okay, for example, a Malaysian company own a foreign subsidiary in the Singapore. The foreign subsidiary prepared financial statement in the Singapore dollar. However, its functional currency is the ringgit. Okay, that foreign currency using a functional currency is the ringgit, but they prepare in a Singapore dollar. In this case, the foreign currency financial statement of the foreign subsidiary need to be remeasured. Okay, remeasure into the ringgit using a temporal method. The key points here is the for a temporal method, a foreign subsidiary not prepare a financial statement using its functional currency. So that is what I have. Okay, and then the things we need to do here, we need to remeasure the financial statement using a temporal method. So when you do a remeasurement, we're going to create a remeasurement gain or loss, and then this remeasurement gain or loss here will be transferred to profit or loss account. So we're going to transfer to the profit or loss account. Okay, and then for the transactions here, for the items relate with the statements of profit or loss here, revenue and expenses, we're going to use the average rates. Okay, revenue and expenses using the average rate. But for the cost of good and depreciation here, using the historical rate. This method is a little bit complicated. Depreciation using the historical rate. Okay, beginning inventory, ending inventory, going to use the its own rates and rates at the when you acquired these two assets. Okay, and then for the translations of statements of financial position, assets and liabilities should be at the historical cost. And then if there is a revaluation, assets and liability need to use a current value or using the current exchange rate. Shares capital and pre-acquisition reserve need to use the date at the acquisition, which is the historical asset. Okay, this one is only the repetitions. Okay, so for temporal methods here is a little bit difficult here, but most of the time the thing that you need to know here is up to slide 1 until slide 44. I'm not going to proceed with the example of temporal method because most of the time we are using closing rate method. Why? Because once parent has a subsidiary, foreign subsidiary, this subsidiary going to prepare a financial statement based on its functional currency. So once the foreign currency prepare the financial statement based on a functional currency, means that the currency when the subsidiary is operate. So we're going to translate this financial statement using a closing rate method. So you need to focus on this method. For temporal, you need to know the difference between a closing rate and a temporal method. So for a temporal here is once the foreign subsidiary do not prepare a financial statement using a functional currency. Okay, so that is a difference. Okay, so you need to know up to slide 1 and slide 44, the difference between temporal methods and the closing rate method. So most of the time we are using a closing rate method because most of the time, mostly the foreign operations that operate in a foreign country, they're going to prepare the financial statement based on their currency. So later on, when the parents going to prepare a consolidated financial statement, they need to translate from foreign currency to Malaysian. Okay, so we're going to focus more on a closing rate methods. Okay, so that is what we have. So any questions that you have here? Any questions here? Okay, so I think that is the end for this chapter. For the next class, we're going to proceed with the EPS. The submissions of your tutorials will be on 30th, 30, so that we're going to have some time to discuss on. Hopefully that by next class, make sure that you study your EPS so that maybe we need one class or one and a half maybe next Monday. Okay, so this Monday we're going to have EPS, and then until Thursday maybe apart we're going to have EPS, and then we discuss a discussion tutorials on the foreign, and then the next Monday we're going to have public holidays. Okay, I just check again why we're talking about this one. I just check again your addendum for those who not yet scanned for the addendum. So we need to plan when we going to discuss your tutorial for the EPS. So we're going to plan about this one. We're going to plan for the next class. I just realized this morning that we're going to miss one class on that 7th of June due to the Agong birthday. So we try to adjust. And next class we discuss when we're supposed to we discuss when we're going to discuss your tutorials on EPS. So we need to discuss that one because then we also need time to cover for another two topic for the operating segment, and the other one is operating segment, and the other one is related party transaction. At least we need to have two class for that two topics. Okay, so we discuss about that one. So for the next class, make sure that you read up on your EPS so that on Thursday maybe we can cover for your operating segment and related party. And then we have another two class which is on 7. Then you have 7 no class, and then on that Thursday we have a class. And then next Monday we're going to have another class before your exam on 15th. Okay, so any questions that you have here? So please prepare for the next class and then submit your tutorials on this 13th at 30th. Okay, any questions that you have? Any questions? Is you okay with that one? So please, this topic is simple. You can score. Topic of test 2 is simple. The foreign, but make sure that you know which rate that we're going to use, but focus on the closing rate. Okay, and then the other one is PS.